Is Invesco a buy or a sell? Let's get started with the model. This is a small cap company, 500 million market cap. They're trading at $8.35 a share, and they have 61 million shares outstanding. Invesco is a mortgage REIT. It distributes at least 90% of its taxable income to its shareholders. The company was incorporated in 2008, headquartered in Atlanta, Georgia. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They do have positive free cash flow each year, which is pretty impressive. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that's negative every year except the trailing 12 months, positive 84 million. Revenue is a sales for the company, and that is negative in 21 and 22, positive in 23 in the trailing 12 months. It's very rare for a company to have negative revenue. This is due to derivative contracts. And look at that dividend they pay, over 19%. And they could cover the dividend 1.6 times with their free cash flow. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows, past year 4, that's 1.8 billion. We discounted those numbers back to today using a weighted average cost of capital. We get a value of the company of $1.6 billion. We divide that by 61 million shares. And we get a calculated stock price of $27. They're trading at $8.35, so they're trading at a 69% discount. It's a really strong buy according to the model. Do you think it's a buy or sell? Let me know in the comments. There are 40 companies in the same industry as IVR, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They're really leveraged, as most companies are in this industry. Their debt-to-equity ratio is 6.1. For every dollar of equity, $6.10 of debt. They pay the highest dividend, 19%. The average is over 12%. They do generate positive free cash flow. The average is negative. They rank 24th in market cap. The stock has gotten beaten down over the years. Price to book is really attractive at 0.5. Also really attractive PE at 6.1. They have the best price to free cash flow at 3.3. That means they're trading at a little over 3 times free cash flow, which means their market cap is 3 times their free cash flow. Here's their free cash flow. If you triple it, it's still a little below their market cap. And they're trading at $8.35, which is between their 52-week low and 52-week high. Here's their percentages right here. They're trading 16% below their 52-week high, 6% above their 52-week low. So they're trading closer to their 52-week low. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd be really sad at $1,800 today, an 82% loss. To summarize, I have them trading at a 69% discount, ranking 3 out of 10. Would I buy it short-term and long-term? 2 out of 10. I'm not too comfortable with this company. Ratios look real good, so 7 out of 10. Amazing price to free cash flow, really nice PE. Financials look pretty weird, especially with the negative revenue, so I'll give it 3 out of 10. Let's take a look at their third quarter earnings slides so we can learn a little more about the company. Here's how they invest their funds. 87% in agency RMBS, that's residential mortgage-backed securities. When it says agency, that means it's backed by the government. For example, Fannie Mae, Freddie Mac, or Ginnie Mae. Agency CMBS, commercial mortgage-backed securities. So the debt is backed by commercial mortgages. Agency CMO, collateralized mortgage obligations. And then 0.3% in credit portfolio. So their total investments is $5.9 billion. The equity in those investments is $857 million. A similar percentage breakdown, 85% RMBS, etc. They footnote the investing section. Footnote 1. Agency RMBS includes specified pools at fair value. Not too much information there. Credit portfolio includes non-agency CMBS and non-agency RMBS. Non-agency means it's not backed by the government. So this may be debt issued by JP Morgan or Goldman Sachs or another bank. Here are some financial results. Net income per share, 63 cents. Book value per share, $9.37. Dividends per share, 40 cents. So that's a little under 70% of their net income. And they provide a return of 5.4%. They plan to redeem Series B preferred stock on December 27th. They're going to issue 88.5 million of common stock. They're going to buy back Series C preferred stock for 1.6 million. They hold a little over half a billion. They hold a little over half a billion of cash. Here are the various yields. The Treasury yield Let's look at the purple line. That's October 31st, 2024. So it's between 4 and 4.5%, depending how long the debt matures. So a 30-year maturity, 4.5%. A 5-year maturity, about 4.2%. Money market rates have gone down a lot. They used to be pretty close to 5.5%. Now they're getting close to 4.5%. Money market funds are highly liquid. It's usually short-term debt, like 3 months or less. Most money market transactions are wholesale. When I say wholesale, I mean they're between financial institutions and companies. You could, as a consumer, get a money market account, but they pay really low interest rates, usually a little higher than a savings account. Here's their coupon allocation for agency RMBS. Coupon is interest payments. As of 9/30/2024, about 28% of their RMBS paid a coupon of 6%, about 25% 5.5%, about 21% 5%, about 12% of their investments paid a coupon of 4.5%, and about 11% paid 4%. The dark blue is 12/31/2023. Only 20% of their portfolio paid a 6% coupon. Now it's about 27-28%. So rates have come up since 12/31/2023. As of 9/30/2024, about 14% of the pool has a high LTV. High LTV is high risk. LTV is loan to value. You want a low loan to value. Because say you buy a home for $1 million. The V is the bottom, the value, and the top of the equation is the loan. Say the loan is $800,000. 800,000 over $1 million is 80%. As you pay down the loan over time, your loan to value goes down. Say after 2 years, your loan is down to $500,000 and the value is still $1 million. Now your LTV is 50%. Even better if the value of the home goes up and the loan goes down, then your LTV gets even lower. Here's agency CMBS. 74% Fannie Mae, 26% Freddie Mac. The total is $675 million. And the spreads are going down. They're getting tighter. It was 75 basis points in the beginning of the year. Now it's about 56 basis points. The tighter the spread, the more liquid the investment. The wider the spread, the more illiquid. They have $73 million of agency CMO. 59% of their portfolio are 30-year bonds with a 2.5% interest. They have $18 million in their other bucket. 56% non-agency CMBS, 44% non-agency RMBS. Look how high the yield is in their agency CMO, almost 10% yield. The coupon's 2.6%. A lot of the yield is not coming from the coupon. It's coming from the principal repayment. They hedge over 90% of their repo agreements, over an 80% hedge in the notional value. When it says hedging, it means they hedge a floating rate for a fixed rate. It's right here. The fixed rate is 1.37%. The floating is 5%. They're hedging $3.8 billion. This is definitely not a straightforward company to value. If you're a little confused, don't worry, it takes time. Feel free to ask questions in the comment section and I'll try to answer them. Their net income for the quarter is $35 million. Last quarter they had a loss of $19 million. Last year a loss of $74 million. Then they have to adjust for the non-cash items like the derivatives. The funds available to distribute as a dividend are $38 million. You can see in prior quarters, even though they had a net loss, they still had cash to give back to the shareholders. So the EPS this quarter is 68 cents. Last quarter they had a net loss, but they have more funds to distribute, 86 cents per share. Last year, $1.51. Because last year they passed through a $224 million loss, a paper loss. So that brings down your net income, but we add it back here. Because remember, net income or net loss is accounting. It's not actual cash. In this quarter, they received $74 million of interest income, and they paid $66 million of interest on their debt. So the net interest was $7.5 million. Last year was over $9 million. This is just a different way to calculate the return to shareholders. You see $38.3 million. If we go to the previous slide, it's also $38.3 million. It's just showing you different ways to calculate the earning. They define credit portfolio, investments in non-agency CMBS and non-agency RMBS. CPR, the constant prepayment rate. This ties into the underlying borrowers, how fast or slow they prepay their mortgages. Some people prepay quickly. Like for example, if a relative died and they left you $100,000, you could put that money towards your mortgage. So your prepayment rate is faster than if you never received that money. Non-agency CMBS, commercial mortgage-backed securities that are not guaranteed by a U.S. government agency, Agency RMBS, residential mortgage-backed securities that are guaranteed by a U.S. government agency, such as Ginnie Mae, Fannie Mae, or Freddie Mac. Let's look at simply Wall Street. Its last price, $835, 507 million market cap, up 2% in the past week, up 2% in the past year. It looks like the stock started trading in 2009 at $200. Of course, nobody IPOs for $200. They definitely did a reverse stock split. This website, stocksplithistory.com, shows you a 1 for 10 reverse stock split in 2022. So if you want to know how much they IPO'd for, you have to divide all the numbers by 10. So it looks like they IPO'd for about $19, which makes sense. Then the peak was $240 about a year or so after IPO. And then it went up and down for nearly a decade. But in February 2020, that's when it fell off a cliff. It went from 180 down to about 20 in about a month or two. It did climb up to over 50, but ever since mid-2020, it's really struggled. It got real low at some points. It was trading as low as $639. Here's the stock price to last year. It looks more normal, the chart. It traded in a pretty tight range the past year, between $7 and $10. Simply Wall Street does not value this company. 3 analysts priced this stock at $883. They say it's 6% undervalued. Here's their revenue since 2013. It looks really odd, right? Because it's negative at a bunch of points. Here's their debt since 2013. It was $17.7 billion. The highest was $20 billion. Then it fell to $740 million. Now it's $5.2 billion. And their equity is usually lower than their debt. Their equity is $850 million, debt $5.2 billion. And they have hardly any cash on their balance sheet, only $60 million. They always pay a really high dividend. It was 12% in 2014. It got up to 61% in 2020. Then they cut their dividend. It got pretty low, 2.5%. It was 26% in 2022. And the forecast is 19% by 2026. 62% of the company is owned by the general public and 38% by institutions. The biggest shareholders, BlackRock at 9%, then Vanguard, 2 Sigma, Murray Asset, Van Eck, Northern Trust, Castle Knight, Goldman, UBS, Citadel. The ticker trades on New York Stock Exchange, Deutsche Börse, and London Stock Exchange. So if you want to learn how to value a stock and figure out whether it's over or undervalued, I'll send you my Excel DCF model for free. Click on the video in the top right corner. Thanks for watching.